approaches to value a company or a business valuation. So this is the intro lah. The intro, we are not going to spend much time on the intro. So how does one value a company? While at a broad level, one may be able to understand why a company may be worth a certain amount to an investor or buyer. So it is not always possible to understand why someone is willing to pay a certain amount or for a business. So again, when it comes to business relation, sometimes the buyer or the potential buyer may not want to pay for the price of the company as stated in the valuation report. So normally, what they will do is they will only use the valuation reported by a valuator as a guidance for them to negotiate the price or the value of the company in any transaction. So it is not like a property valuation whereby normally buyer and seller will just follow or use whatever value reported in the valuation report, because as far as real estate valuation is concerned, the value can easily be determined. But as far as a business relation is concerned, the value is a bit tricky to be determined, because there are a lot of elements to be considered when we value a company. So whatever value that we report in the valuation report is not necessarily used or accepted by both parties in the transaction. So in some cases, the value is only used as a basis of their negotiation. At least they know if they want to negotiate or bargain on the price that they should pay for the company. At least they have some basis or guideline. So a business worth a significant amount at a certain point in time may suddenly lose much of its value a very short while later. This is what happened in many companies commonly referred to as dot-com companies, which were valued at amounts which may seem absurd now. So especially when we are facing this pandemic situation at the moment. So maybe, let's say, if the company has been valued a few months ago or end of last year, just slightly before the pandemics come into pictures, whatever value which is reported in the valuation report slightly affected or slightly different as it is now, because if the parties or the seller and buyers are negotiating now to buy and sell a company, they might take into consideration the impact of COVID-19 to the company. As I mentioned a few weeks ago, when we are discussing about business relation, it is about the future. So whoever you guys can hear my voice, kan?
Boleh, boleh.
Boleh, sir.
Okay, so when it comes to a company, normally what they will do is they will focus more on the future. So because the reason why we buy any company is for their prospect of future income, not for their past performance. So the past performance is only used as a benchmark together with forecasting for the future to determine the value of the company. So sometimes whatever happened in the past may not happen again in the future. For example, even though the company has made a huge profit for the last 3 to 5 years before the pandemic COVID-19 comes into picture, the same company may not be able to produce the same amount of profit for the next 2 3 years as a result of the impact of COVID-19 to the business. So that's why we have to bear in mind the buyers is more interested on the future potential of the company, not the past performance of the company. But of course, somehow the past performance will have some impact on the future of the company because by looking at the past performance, if the company has been managed effectively, so it can assure the buyers that the company may be able to maintain or to sustain their level of profit. But as it is now, since we are having the pandemic problem, so the ability of the company to sustain their past or current profit may be a factor. So that's why when any company wants to buy a company, they will negotiate on the value. They are not going to just receive whatever amount, or they're not going to totally accept whatever amount which is reported in the valuation report. So they will still negotiate with the buyers, especially on the forecasting part. Because sometimes uh, whether or not the company could manage to produce a profit which is expected as reported in the valuation report, it totally depends on the economic condition or situation. So if the valuator has done a thorough analysis when they do the forecasting for the future, so most probably their forecasting is um, accurate. But there are some cases whereby while do the analysis to forecast for the future, the evaluator may miss some of the important elements, so that it may affect the potential of the company to produce profit in the future. So we have to bear in mind lah, that sort of situation, or that sort of condition which may have huge impact on the company value. So why do values of company change from time to time? Does value depend on whether one wants to sell a company, to buy a minority stake, or to buy the entire company? So will a strategic investor value a company differently from a financial investor? How can a company which is continually losing money have a value? So this is also quite an issue. Let's say because sometimes, even though the company has continually losing money, it doesn't mean that they don't have prospect to make profit in the future. So it is very crucial, very important to the evaluator to do the fair forecasting for the company, especially those uh, who are losing money for the past few years. So how do we as evaluator can convince the potential buyer that even though the company has losing money for the past few years based on the financial statements, but the company can potentially recover and make profit in the future. So that's where the forecasting part in the valuation process is important. So as a valuator, as a valuer who do a business relation, we have to be fair enough. So it doesn't mean that if the company lose money in the past, they don't have profit to make profit in the future. It doesn't mean that the company has made a good profit in the past, they cannot fail or losing money in the future. So it's all depends on the economic. It all depends on the forecasting that the valuator or valuer do. While it has some degree of uncertainty. So that's why, as I mentioned earlier, most of the time the both parties, the sellers and the buyers lah especially, they will not 100% accept the value which is reported in the valuation report. They will try to negotiate. Will in the negotiation they will come with their own justification on why the company, from their perspective, is not worth as quoted in the valuation report. After all, a valuation is about a valuer or valuator opinion on how much the company worth in terms of money. So it can be it still can be negotiated when it comes to uh, buying or selling companies is concerned. So when doing the valuation, the valuator must understand the issues which may impact or which has impact on the valuation. So this is the definition of value. What is value? We are not going to spend much time on that. When I upload this slide, you can see lah the definition of value. So this is again the purpose of doing valuation for a business. Most of the time to for sell and purchase, merger and acquisition. Merger and acquisition ni dalam bahasa Melayu is pengambil alihan dan percantuman syarikat dia merge. So this is among the purpose of valuation. So this is the approaches that is usually used in business valuation. So basically there are three approaches. So for each of the approaches, so for each of the approach, there will be some there are a few methods that can be used. So the first approach is asset or cost approach. So the second one is income approach, and the last one is market approach. So when we are doing lecture in week 3, so in the slide it is stated that before you can choose a specific approach to be used in valuing the business, we must first consider all three approaches.
So
So after we have considered all three approaches, then only we will choose
what
what is the best
approach
approach
to
to
value the
value the
company.
company.
So it
So
will
it will
depends
depends
on
on
case by
case by
case
case
basis.
basis.
Some of the
Some of the
company
company
maybe
maybe
asset
asset
approach is
approach
the
is the
best
best
to value
to
the
value the
company.
company.
But some
But some
company
company
maybe
maybe
income
income
approach is the
approach is the
best.
best.
And
And
on the other
on the
hand,
other hand,
some
some
companies
companies
maybe
maybe
market
market
approach is the
approach is
best
the
to
best
value
to
the
value the
company. So that's
company. So
why
that's why
it is
it is
always
always
stated or
stated or
mentioned that
mentioned that
before
before
a
a
valuator
valuator
choose
choose
an
an
approach
approach
to be
to be
used
used
in order
in
to
order
value
to
the
value the
company,
company,
we
we
must
must
consider
consider
all
all
approaches
approaches
first. So
first.
after
So
we
after we
have
have
taken
taken
into
into
consideration
consideration
the pro
the
and
pro and
cons
cons
of
of
each
each
approach,
approach,
then
then
only we
only
will
we will
choose
choose
what is the
what is the
best
best
approach
approach
to
to
be
be
used.
used.
Because some
Because some
approach
approach
we
we
may
may
not
not
get
get
data
data
for that
for that
particular
particular
company. So
company.
that's
So that's
why
why
maybe that
maybe that
approach
approach
will
will
not
not
be the
be the
best
best
approach as
approach
far
as
as the
far as the
company is
company is
concerned. So
concerned. So
it
it
always
always
be
be
based on
based on
case by
case by
case
case
scenario. So
scenario.
we
So
cannot
we
say
cannot
that
say that
asset
asset
approach is the
approach is the
best
best
approach to
approach to
value
value
a
a
company or
company or
income approach.
income approach.
It
It
totally
totally
depends on
depends on case by
case
case
basis.
basis.
As I mentioned
As I mentioned
earlier,
earlier,
maybe
maybe
for some
for
type of
some type of
company,
company,
market
market
approach is the
approach is the
best.
best.
But
But
for
for
other types
other
of
types of
company,
company,
maybe
maybe
income
income
approach is the
approach is
best.
the
So
best. So
it's
it's
totally
totally
entire to
entire to
evaluator to
evaluator to
do
do
a
a
study
study
before
before
we
we
choose
choose
which
which
approach
approach
is the
is the
best
best
to
to
use
use
in
in
valuing the
valuing the
company.
company.
So
So
different
different
experts
experts
have
have
different
different
classifications
classifications
of the
of the
various
various
methods.
methods of
Within these
within these
methods, there
methods
are
there are
sub
sub
methods.
methods.
So
So
sometimes the
sometimes the
methods are
methods are
overlapped.
overlapped.
So within
So
these
within these
approaches,
approaches,
they're supposed to be
supposed to be
within these
within these
approaches, there
approaches
are
there are
different
different
methods.
methods.
So the
So the
first
first
one,
one,
let's look
let's
at
look at
each of
each
the
of the
approaches.
approaches.
The first
The
one
first one
is
is
asset
asset
or
or cost
cost-based
based
approach.
approach.
So under the
So under the
cost-based
cost-based
approach or
approach or
methods, we
methods,
have
we
book
have book
value,
value,
replacement
replacement
value,
value,
liquidation
liquidation
value.
value.
So this
So
is
this is the
a
a
method
method
that can be
that can be
used
used
under
under
asset or
asset or
cost
cost
approach.
approach.
So
So
for book
for book
value
value
method,
method,
so we will
so we
look
will
at
look
the
at the
historical
historical
cost
cost
valuation. So what
valuation.
is
So
a
what is a
historical
historical
cost?
cost?
So it is
So it
mentioned
is
here,
mentioned
all
here all
assets
assets
are
are
taken
taken
at
at
historical book
historical book
value.
value.
So
So
if you
if
look
you
at the
look at the
accounting
accounting
principles, when
principles
we
when
do
we do
our
our
accounting and
accounting and
financial
financial
management
management
subject
subject
2 years
2 years
ago,
ago,
there will be a
there will be a
concept of
concept of
historical
historical
value.
value.
So what
So what
does
does
historical
historical
value mean?
value means?
So that's
So
why
that's why
I said
I
you
said
need to
you need to
recall back
recall
your
back your
memory, your
memory, your
knowledge
knowledge
from the
from the
previous
previous
subject. So you
subject. So
have
you
to
have to
know what
know
is a
what is a
historical
historical
value, what is a
value, what
book
is a book
value. So
value.
I will
So I
put
will put
this
this
in your
in your
tutorial so that
tutorial so that
can
you can
have a look
have a
what
look what
does it
does
mean
it
with
means with
historical value
historical
or book
value or book
value.
value.
So
So
value of
value of
goodwill.
goodwill.
So
So
again, you need
again,
to
you
know
need to
what is
know
a
what is a
goodwill
goodwill
before you can
before you
value
can
a
value a
company
company
which
which
has
has
a
a
goodwill
goodwill
element. You
element.
need to
You
know
need to
what is
know
a
what is a
goodwill.
goodwill.
what is the elements of goodwill, what is the characteristic of goodwill. So
So
if we are
if we are
doing
doing
book
book
value
value
method
method
under
under
asset
asset
approach,
approach,
so we need
so
to
we
know
need to
what is
know
a
what is a
goodwill.
goodwill.
So value
So
of a
value of a
goodwill
goodwill
is
is
added
added
to
to
this
this
above
above
figure to
figure
arrive
to
at
arrive at
the
the
valuation.
valuation.
So you
So
need to
you
know
need to
what
know
is a
what is a
goodwill. So it
goodwill. So
is
it is
mentioned here. We
mentioned
will
here.
see
We will
how
see how
goodwill is
goodwill is
valued
valued
later
later
in
in
slides.
slides. Ini the same slide ni.
So
So
current
current
cost
cost
valuation.
valuation. All assets are taken at current
value
and
sum to
sum
arrive
to
at
arrive at
value.
value.
This
This includes
includes
tangible asset, intangible asset, investment, stocks,
and
and
receivable.
receivable.
So
So what is the differences between historical cost valuation and
current
current
cost
cost
valuation?
valuation?
So
So
anybody has any
anybody has any
idea
idea what is the differences between
historical cost
historical cost
valuation
valuation or book value
and
and
current
current
cost
cost
valuation?
valuation?
Is there any
Is there any
difference?
difference?
Anybody has any
Anybody has
idea?
any idea?
What the difference?
What is the
What is the
difference?
difference?
Current cost yang latest one.
Yeah, that one
Yalah,
is
that
the
one
most
is the
simple
most simple
answer
answer
lah.
lah. Current cost is the latest one.
Everybody
Everybody know lah.
Current cost is the latest
the
one.
latest one.
So what is
So
the
what is the
differences?
differences?
Can we
Can
say
we
that
say that
current
current
cost
cost is
a
a cost after we have
taken
taken into consideration depreciation or appreciation?
Can we say
Like that?
or cannot?
Or cannot?
Tapi historical pun ada take in consideration of depreciation barang macam ni kan. Macam dalam financial statement annual report pun ada.
I don't know. I ask you. I'm not expecting for questions from you. I am expecting you to try to answer what is the differences between current cost valuation and historical cost. So the basic principle is what is the differences between historical cost and current cost?
What does
What does historical
mean?
cost means?
As I mentioned
As I mentioned earlier, in accounting, there is a concept of book value.
So what does
So what does a book value means?
So that's why
So that's why we need to recall back what is a book value, what is historical cost, what is a current cost. Then after we know what is historical cost, what is current cost, only we can
use
use under
book
book value method, the historical cost valuation. So
when
when we
we
refer as
historical
historical cost valuation, is it the
original
original amount of money that we pay when we buy the asset?
Yes.
So when we say current the cost, the current cost after taking into consideration depreciation or appreciation, because remember some asset there has been an element of depreciation which will affect the value of
the
the asset. But for some asset, it has the element of appreciation. Again, either depreciation or appreciation,
it will
it will have impact on the value of the asset. So that's why we need to know what is the differences between current cost and historical cost, book value. So never mind, I'll put that in tutorial questions so that we can discuss later. So you need to find some info first. What does current cost and historical cost means as far as accounting and business relation is concerned?
Because
Because if you do not know what is the differences between historical cost and current cost,
you
you cannot use this book value method in order to
you need
you need to know. exactly what does current cost and historical means before you can use this book value method to value the company. So current cost valuation, all assets are taken at current value and summed to arrive at value. This includes tangible assets, intangible assets, investments, stocks, and receivable. So again, it is a question at the bottom of the slides. What do you think could be difficulties in this method? What do you think could be difficulties in using book value method to value a business? It could be anything, right?
Finding the current value of the asset.
Yeah. Most of the time is how to determine the depreciation rate. Because I'm not sure whether you are aware of or not. In determine the depreciation rate for any of the asset, we have a few approaches that can be used. One of the approach is straight line approach, kaedah garis lurus. So straight line approach is one of the method that can be used in determining the depreciation for any of the company's asset. So that's why again, as I mentioned, you need to recall back your knowledge from your memory on the accounting part. So current cost valuation, this is the potential difficulties for current cost valuation. So we may face difficulties when value a technology to value tangible asset. For technology, so sometimes technology is not included in balance sheet. So if the technology is not included in the balance sheet, how do we determine the value? So normally if you look at the balance sheet, what is reported in the balance sheet is normally the tangible asset, either the vehicles or debtors or inventories. How about technologies? If the technologies element is not being reported in balance sheet, how do we determine the value? The value of technology that the company has. So it could be one of the challenges that we may have to face when it comes to technology valuation. Tangible asset valuation of fixed asset in use may not be a straightforward or easy exercise as you may expect. Normally, what is the issues with tangible asset? Again, as I mentioned earlier, most of the time the main issues with a tangible asset valuation is depreciation. How to determine depreciation? Sometimes we cannot just simply use straight line method to determine the depreciation for tangible asset, because sometimes by using straight line depreciation method, you will reduce the huge amount of value from the tangible asset. So that's why we need to carefully consider what is the best method to determine depreciation for tangible asset. As it mentioned here lah. Sometimes it may look like very straightforward.
determine the
depreciation
depreciation
for
for
tangible
tangible
asset.
asset.
So among
So
the
among
tangible
the
asset
tangible
that
asset that
can
can
be
be
problematic
problematic
to
to
determine
determine
the
the
depreciation
depreciation
is
is
plant and
plant and
machinery.
machinery.
How do
How do
we
we
determine
determine
the
the
depreciation
depreciation
for
for
plant and
plant and
machinery?
machinery?
For real
For real
estate, for
estate, for
building, it's
building
not
is not
that
that
difficult.
difficult,
But for
but
plant
for
and
plant and
machinery,
machinery, because plant and machinery will depends on their
life
life
cycle,
cycle,
the
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 ability of the
ability of the
machine to
machine to
produce a
produce a
product. So
product. So
normally the
normally the
depreciation
depreciation
is
is
uh,
uh,
determined
determined
by
by
that
that
element.
element.
Let's say if
Let's say
the
if
machine
the
has
machine has
10
10
years
years
uh,
uh,
of life.
of life.
So
So
maybe
maybe
within the
within the
first three
first
to
three
five
to five
years,
years,
it
it
can
can
produce
produce
product
product
optimally. So
optimally.
what will
So what
happen
will
after
happen after 5
5 years?
years?
In year
In
6,
year
7,
6,
8,
7,
9,
8,
10,
9, 10,
how
how
much
much
how
how
much
much
depreciation
depreciation
do we
do
need
we
to
need to
deduct
deduct
from the
from the
asset,
asset,
plant and
plant and
machinery?
machinery?
So this
So
is
this is
maybe one
maybe
of
one
the
of the
aspect
aspect
that
that
one of the
one of the
difficulties or
difficulties or
challenges or
challenges or
problem that
problem that we may
face
face
when it
when
comes
it
to
comes to
book value
book value
method ni,
method
in
ni,
order to
in order to
determine the
determine the
current
current
cost
cost
for that
for that
particular
particular
asset.
asset.
So this
So
is
this is
another
another
difficulties,
difficulties, the potential
or
difficulties or
challenges
challenges
that we
that we
may
may
face
face
while
while
valuing a
valuing a
company
company
using this
using this
method. So
method.
the
So
company
the
is
company
not
is
a
not a
simple
simple
sum of
sum of
standalone
standalone
elements in the
elements in the
balance sheet.
balance sheet.
Organization
Organization
capital is
capital is
difficult to
difficult to
capture in a
capture in a
number.
number.
This
This
includes
includes
employees,
employees,
customer
customer
relations,
relations, industry
standing and
standing and
network,
network,
capital.
capital.
So this is
So
the
this is the
element of the
element of the
capital
capital
which
which
may be
may be
difficult
difficult
for us
for
to
us to
capture or to
capture or to
determine.
determine.
So this is
So this is
again
again
the
the
potential
potential
challenges
challenges
or
or
difficulties that
difficulties
we
that we
may
may
have to
have to
face
face
when
when
doing
doing
valuation
valuation
for a
for a
company
company
using this
using this
method,
method,
goodwill.
goodwill.
So based
So
on
based on
capital
capital
employed and
employed and
expected
expected
profit
profit
versus
versus
actual
actual
profit,
profit,
based on
based on numbers of
years
years
of
of
super
super
profits
profits
expected may
expected
be
may be
discounted at
discounted at
suitable rate.
suitable rate.
Before
Before we can understand this one, we need to know
what is
what is
actually a
actually a
goodwill.
goodwill.
So you need
So
to
you need
know
to know
what
what
constitute a
constitute a
goodwill.
goodwill.
What is the
What is the
characteristic
characteristic
of
of
goodwill? What is the
goodwill? What is the
elements of
elements of
goodwill?
goodwill?
Because if
Because
you do
if
not
you
know
do
what
not
is a
know what is a
goodwill,
goodwill, how
how
come
come
we
can
can value goodwill? Because
because
goodwill
goodwill
has
has
an
an
impact
impact
on
on
the
the
companies
companies
or
or
on
on
a
a
business,
business,
on
on
a
a
firm's
firm's
value.
value.
Some
Some
company
company
they
they
may
may
have
have
a
a
high
high
value
value
of
of
goodwill.
goodwill.
Some
Some
company
company
they
they
may
may
not
not
have
have
a
a
high
high
value of
of
goodwill.
goodwill.
So
So
as
as
a
a
valuator,
valuator,
as
as
a
a
valuer
valuer
who
who
will
will
carry
carry
out
out
a
a
valuation
valuation
on
on
that
that
particular
particular
company,
company,
we
we
need
need
to
to
know
know
what
what
is
is
the
the
company's
company's
goodwill,
goodwill,
what
what
is
is
the
the
impact
impact
of
of
the
the
company's
company's
goodwill
goodwill
on
on
the
the
company's
company's
value.
value.
So
So
therefore,
therefore,
we
we
need
need
to
to
know
know
what
what
is
is
actually
actually
a
a
goodwill
goodwill
to
to
that
that
company.
company.
We
We
need
need
to
to
investigate
investigate
lah.
lah.
So
So
again,
again,
this
this
is
is
all
all
about
about
goodwill. So
so
that's
that's
why,
why,
as
as
I
I
mentioned
mentioned
earlier,
earlier,
when
when
we
we
are
are
valuing
valuing
a
a
company,
company,
we
we
cannot
cannot
simply
simply say, oh, we are going to use asset approach to value this company, we need to consider first. We need to consider all approaches first. As I mentioned earlier, because maybe some of the approaches is not suitable to be used to value the company. Like for instance, if we are having difficulties to determine the value of goodwill for the company, how to determine the current cost, current value of the company. So we may not use asset approach to value the company. We may use income approach or market approach instead of asset approach. So you need to use or choose the best approach to value the company. You must have a strong justification on why that approach is chosen to value the company. We're not going to look at the example yet. We will do example with Dr. Zai later on. So what is IA? What does IA stand for?
Intangible asset.
Intangible asset.
Intellectual asset.
Apa IA? Kalau AI is artificial intelligence, right? IA.
Betul. Intangible asset.
Normally IA is as far as business relation is concerned, IA is intangible asset. So we need to determine what type of intangible asset that the company has, because maybe different types of intangible asset has different method to be used to value. So we need to identify what type of intangible asset that the company has. Is it patent ke, copyright ke, is it a license ke? So we need to determine. So the value of the intangible asset is from economic benefit provider, specific usage to the business or to the company. So normally intangible asset has different aspects. So among the aspect is accounting value, economic value, technical value. So what is accounting value? What is economic value? What is a technical value? So we need to know different type of intangible assets, blah blah blah, and then what is the value that the intangible asset has. Is it accounting value? Is it economic value? Is it technical value? Then we need to know what is the differences between accounting value, economic value, and technical value. That's why I said at the beginning of this semester when we do some introduction for this subject, this subject is actually a heavy subject. So to do this subject within one semester, 14 weeks, it is impossible. So, but as far as our syllabus is concerned, we try to give you an introduction to business relation. So, as it is now in our industries, this business relation is done by experienced valuer. So if you look at the topic that we have done before this, in order for you to be qualified to do a business valuation case, you must have certain knowledge, especially on the company's asset, the type types of companies. The different type of company may have a different type of asset. So you need to know like what type of asset a sole proprietorship company has. What type of asset that the partnership normally have. What type of asset that public limited company normally have. What type of asset private limited company normally have. For public limited company, normally we can value for the whole company. We can value for the minority share. We can value for the majority share. So it depends. So it is very important for anybody who wants to take a job to value a company really knows about the element of the business valuation, because as I mentioned last time, business valuation is not as a straightforward as a real estate or building valuation. Because if you are doing real estate or property valuation, it is quite straightforward. But with business ni, because it involve different types of asset, the tangible one could not be that problem. The most problematic one is intangible asset, because normally as a valuer, we may not know what is a goodwill, what is intangible asset, what is the types, different types of intangible asset, what is the differences between patent and copyright. Before you can do a business relation, you need to know, you need to have knowledge on all those aspects. Otherwise, you may end up giving a wrong value to the company. You may overvalue or devalue the company, so which is dangerous lah to your profession, because you may end up being sued by the clients. So intangible asset depends on objective and can vary widely depending on the purpose. So what is the purpose of the company having intangible assets? For instance, patent or copyright. So what is the purpose of company to have copyrights in their company? So for accounting purposes, all these IA should appear in the company's financial statement. So again, if the type of IA does not appear in any of the company's financial statement, how do we get the data? Because if it is appear, or if it is shown in this financial statement, maybe it is quite easy for you guys to wait. If it is not appear, or it is not reported in the company's financial statement, then it will become more problematic later in order to determine the elements of intangible asset that the company has. By hook or by crook, you need to get the info, regardless whether it is reported or not in the company's financial statement. So for merger, acquisition, or investment, for management to understand value of company for making. So especially for if you are doing valuation for acquisition or merger or investment. So the potential buyer, the potential investors need to know what type of intangible asset that the company has, and then what is the potential benefit of the intangible asset to the company. Will the intangible asset that the company has increase the potential profit or the potential income that the company is going to generate in the future? So all these info, all these elements must be clear and made known to the potential buyer, potential investors, potential company that is going to merge or that is going to acquire the company that we are value. So we need to be transparent enough in doing the valuation. That's why at the beginning, before we accept any business valuation case, we need to scrutinize the engagement letter. By looking at the engagement letter, we will know what is our responsibility, what type of company, what type of asset that we are going to value, what is the risk if we fail to carry on the task, if we fail to do the task, what is the implication? So that's why, as part of your assignment, the engagement letter is very important. So normally for a valuation company or any accountants that do business valuation cases, before they will accept the case, they will look at the details which is included in engagement letter. So by looking at the engagement letter, if the company feels that they are not capable to do the valuation case, then they will not accept the case. They will reject the case. So the engagement letter actually is very important process, the earliest stage before we do business valuation. So before we decided to accept the case, we must make sure that we know lah all the approaches which is available to value a business, a company. What is the nature of the company or the business that we are going to value? So what is the risk if we fail to perform our duty as a valuator or as a valuer who value the company? So we need to consider all those factors. So far, do you have any questions? Intangible asset value in transactions, often value paid in merger and acquisition deals. M&A ni refer to merger and acquisition. I think before I upload this slide in Spectrum, I will put in a full apa ni lah, instead of M&A. So to avoid any misunderstanding. But normally, as far as business valuation is concerned, for merger and acquisition, we always put as M&A. M&A stands for merger and acquisition, pencantuman dan pengambil alihan syarikat. So often value paid in merger and acquisition deals is more than market value or book value. This could be partly due to overbidding due to strategic reason, partly due to intangible asset of company not captured in balance sheet. So this is the case scenario lah. As it is mentioned here, normally for merger and acquisition deals, per asset value often will often more than market value. So normally for merger and acquisition, the buyers normally is willing to pay more for intangible asset. The buyer are willing to pay more than the reported market value or book value. So this is among the reason lah why the buyers willing to pay more for the intangible asset. So one of the reason is due to overbidding. Maybe because the company has received quite a number of bidders to acquire or to merge with the company. So maybe among the bidders, they are willing to pay more in order to win the bidding process. So the other reason is due to intangible asset is not captured in balance sheet. So sometimes if the intangible asset is not captured or is not shown in the balance sheet, it may end up that the buyers, the investors pay more than the market or book value. So this is the second method can be used under asset approach, which is replacement value method. So remember, as I mentioned earlier, in valuing a business, we have three main approaches. The first approach is asset or cost approach. The second one is income approach. And the third one is market approach. Under each of these approach, we have different methods. So just now we have gone through the historical book value method. So this one is replacement value method. So both is under asset approach. So what is replacement value method? So it is about the cost of replacing existing business as the value of the business. So if you are using replacement value method, we are estimating the cost of replacing existing business as the value of the business. So in real estate valuation pun, we have this type of method, cost method. So we will estimate what is the cost to replace current building. So the cost of replacing current building will be considered as the value of the. But as far as the business is concerned, so if you are using replacement value method, so we are estimating the cost to replace existing business as the value of the business. So by looking at the slide, it may look like quite simple, but it is not as simple as we think. That remember, to value a company, a business, regardless whether which approach, which method that you are using, there always will be some difficulties or challenges that you may face in the process of valuing the business. This is because maybe the nature of the business, maybe the market condition, or maybe due to the lack of information. Because as we gone through just now, for intangible asset, some of the intangible asset is not reported, not appeared, not shown in the financial statement. So if that is the case, so we may have problems to determine the value of the intangible asset. As far as the business is concerned, intangible asset may have impact on the overall value of the company. So we have to know lah, we have to aware what type of intangible asset that the company has, how to value or how to determine the value of different type of intangible asset. Because some of the intangible asset, the value will be based on the usage of the intangible asset, but some of the intangible asset, the value is determined by the lifespan of the intangible asset. So if you look at the topic for intangible asset, most of the intangible asset has the legal impact of the different type of intangible asset. For instance, copyright, patent. So normally copyright and patent, they have their lifespan, 30 years, 25 years, 15 years. So when we are doing valuation on the intangible asset, we must know lah the element that would determine the value of different types of intangible asset. So that's why, as I said, to learn everything in details within 14 weeks, it is quite impossible. But we are trying to share as much as possible lah the aspect of business valuation with you guys. Even at the end of this semester, if you get A for this subject, it doesn't mean that you are qualified to be a business valuation evaluator. So what we teach you in this subject is very basic knowledge, very basic information on business valuation. In order for you to be qualified to do or to carry out business valuation cases, you need elements of experience for you guys to be able to do a business valuation cases. So this is again that we can use under asset approach, which is liquidation method, liquidation value method. Value if the company is not a going concern. So looking from the accounting principle, what does going concern means? Anybody has any idea? What does going concern mean as far as accounting is concerned? Going concern. So going concern is one of the principle in accounting. So what does the going concern principle tell us? Anybody has any idea, anything to share about going concern? What does going concern actually means to a business?
Assume the business is going to operate forever.
Yeah. So that's why if you are doing valuation, business valuation using liquidation value method, so we need to know lah what is the value of the company is the company going to stop its operation. Itu yang dia kata tu, value if company is not going concern. Because referring to going concern principles, we are assuming, we are expecting to will operate forever. Forever to meaning that in a longer term lah. It is impossible lah for the company to operate forever. But as far as the accounting principles of going concern is concerned, we are expecting the company to operate as long as possible in the future. We don't expect the company operate for 2-3 years, after that going bankrupt. So that what it means with going concern lah. So liquidation method. Why liquidation method and replacement method ni is not being explained in detail? Because normally for asset approach, most of the popular method and methods, book value and replacement value ni. So most of the time when a evaluator value a company using asset approach, the method that is going to be used is historical value method tadi tu, yang the first one. So but we have another methods that can be considered in valuing a business. But for instance, like replacement method, sometimes we may find it is quite difficult to use a replacement method to value a company. But again, it will depends on the type of company, the nature of the business. Maybe for some type of company, we may be able to use a replacement value method to value the company. So the second is income approach. So normally when it comes to income approach ni, as its name ni, it will involve cash flow. So this is where the DCF, discounted cash flow, comes into pictures. So again, you need to make sure that you know about DCF, how to determine the PV, how to determine the discounted cash flow, net present value, semua tu lah. You must recall back your knowledge on DCF. So this is one of the methods that can be used under income approach, which is discounted cash flow method. So you have learned right about DCF. If I'm not mistaken, you have learned about DCF in your investment analysis subject, in your investment valuation subject. So by right, you should be familiar with DCF. Because DCF is one of the methods that can be used in order to value a business under income approach. So earnings capitalization method, this method is also as a profit earnings capacity value, PECV. The company's value is determined by capitalizing its earning at rate considered suitable. Assumptions is that the future earnings potential of the company is the underlying value driver of the business, suitable for fairly established business having predictable revenue and cost. So this is element that we need to know lah when we are using this discounted cash flow ni. So earning capitalization methods. So what actually we do when the company's cash flow, what actually we do when we discounted the company's cash flow? What does discounted means?
calculates to discount it to present value, to discount the future value into present value.
Yeah, that's what basically we do with discounted cash flow. But in order to get or to arrive at a correct or at a fair value of the businesses, we must have a reasonable cash flow lah, kan? Because when we are forecasting about the future company's cash flow, we may have to ensure that whatever income or cash flow generation for the future to whatever the forecasting to must be accurate. If the forecasting for the future cash flow for the company is not accurate, then it will affect our DCF. Because DCF is just a process of the discounting the future income to the current or present value. So we want to know basically what we'll do with DCF is we are measuring the amount of $1 or what DCF ni. You discounted. What is the formula of DCF? Whatever future cash flow tu you PV kan dia kan. You multiply kan dengan PV. PV is 1 over A kan. A is 1 plus I. So you need to know lah for how many years that you are going to discount the cash flow. What is the rate to be used? The I rate to the interest rate to be used in the discounted or discounting process too. So it will affect your final value. So how to determine the I, the interest rate to be used in the formula when you PV your future cash flow. Because the future cash flow is not that critical. What is critical is the interest rate that you are going to use in your formula. I plus I to the power of n. N is the number of years. It doesn't really a problem punya issue. N. Most of the problem is I. Even when if you sit for your TPC to become a registered valuer or registered estate agent, one of the question is how to determine I, the rate to be used in your DCF nya formula ke apa ke. So what is the rate for I tu that we are going to use in our formula? Interest tu.
Depend on the industrial average.
Normally it depends lah. Depends on there will be a range kan for I to be used. But you need to justify lah. Let's say if you use 2-3%, what is the justification why you use 2 or 3%? So it depends. Because the value of the company is totally depends on your capitalization rate to the I that you use in the formula. So this is the discounted cash flow method lah. This one should be okay. Maybe we can do some exercise in your tutorial on how to do the DCF ni lah. We may use example from a few companies punya cash flow, and then we will try to get the DCF. So DCF ni can be easily if you use Excel to determine the every slice punya present value tu. So nowadays people are using Excel to compute the DCF for the company. So you just set the formula in your Excel, and then once you change the figure, so you will automatically get the answer. So by right, you should be able to do it lah. How to use Excel to compute or to calculate the DCF for the company. So so this is the applicability of the DCF method: cash flow to equity, cash flow to firms. So what does cash means? Discount rate reflects cost of equity. So if cash flow to equity, the discount rate that you are going to use must be the discount rate that reflects cost of equity. What is cost of equity? I think you have learned in your real estate investment analysis subject. Cost of capital. Cost of capital is divided into two: cost of debt and cost of equity. So what is the differences between cost of debt and cost of equity? Which one is higher? Is it cost of debt or cost of equity? So normally most of the company, they will finance their capital using these two sources, debt and equity. So each of these method of financing the company's capital has their own cost. If it is cost of if the company using debt, there will be a cost of debt. If the company is using equity to finance the capital, it will be affected by cost of equity. So what is the differences between cost of debt and cost of equity? So you need to know lah, because when you are doing this F for cash flow to equity, the discount rate that we are going to use must reflect the cost of equity. So if we are using the DCF for cash flow to firm, the discount rate that we are going to use must reflect the WACC of the company, weighted average cost of capital. Again, you need to recall back your understanding on WACC. What is WACC? And dekat sini, you need to know lah dekat sini. Cost of capital is break up into two, which is cost of debt and cost of equity. What is cost of debt? What is cost of equity? You need to know. You need to recall back your memory, your from your previous subjects. So what is WACC? What is the impact of WACC to the company? So that's what we need to know. So if we are using cash flow or discounted cash flow to calculate cash flow to equity, so you need to know. You need to use the discount rate which reflects cost of equity. To determine the discount rate that reflects cost of equity, you need to know what is cost of equity. What is the impact or the effect of cost of equity to the company. So you need to recall back lah. Korek balik nota yang real estate investment analysis yang Dr. Aino dengan Dr. Olan ajar itu tu. You need to look back at your notes tu. So if you are applying DCF to determine a cash flow to firm, you need to make sure that the discount rate reflect the company's WACC. So what is WACC? Again, please refer to your real estate investment analysis notes. Should you have any problems to recall back or to understand what is cost of debt, cost of equity, what is WACC, we may discuss lah during your tutorial, or we may discuss in WhatsApp group or in Spectrum. So maybe I will create a forum or discussion platform in Spectrum for you guys to discuss, to share about the previous knowledge that you have already acquired in your previous subject. So you need to recall all those knowledge in order to understand the whole pictures of business relation, because we can't afford to do it during our subject because apa ni lah previous knowledge that you need to recall back. We are not going to give you lecture on what is WACC, what is cost of debt, what is cost of equity, because you already have that knowledge during your previous semester. So by right, you should be able to recall back lah. And if you do not understand or you already forgot about the apa ni, you need to do some revision. So cash flow to equity, valuation of equity stake in business based on expected cash flow. So this is if you are applying DCF on cash flow to equity. What does cash flow to equity means? Inilah, if you are valuing equity stake in a business. So if we are valuing the equity stake of the business, meaning that we are measuring the cash flow to equity. So if we are measuring the cash flow to equity, we have to make sure that the discounted rate reflects the cost of equity. Yeah, this is the explanation lah on where to use the rate which reflects the cost of equity. So the rate which reflects the cost of equity should be used if you are valuing equity stake in the company. If you are valuing a business or a firm as a whole, then you should use discount rate that reflects the WACC of the company. So that is the differences between cash flow to equity and cash flow to firm. So this is what it's all about lah. Cash flow to firm. Value of firm for all claims holders includes equity investors and lenders. So meaning that you are valuing the whole company. So this is the formula of DCF. You may already be familiar lah with this formula because you have learned this topic previously. So value is the sum of what is CF? CF is cash flow, T is the year, and R is the discount rate. So if you are using, so if you are valuing the firm to equity value, so R should be the discount rate that reflect the cost of equity. If you are valuing the firm, so this R should reflect the cost of the whole capital, which is WACC, weighted average cost of capital. So this is the applicability of DCF. DCF is based on expected cash flow and discount rate. So if you are valuing a company using DCF, you have to ensure that the future cash flow, the expected cash flow is reasonable. How do we determine the expected or future cash flow? So we will projected or forecasted the future cash flow
based on current and past cash flow. So from current and past cash flow, we will then project it for the future cash flow. So in projecting the future cash flow, you have to be very careful. We don't want to over project the cash flow or devalue or reduce or project low cash flow for the company. So you have to consider all aspects when you are projecting the company's future cash flow, because the forecasted future cash flow with the discount rates used will impact or will have effect on the company's value. So if you are forecasting for a lower cash flow, then you will devalue the company. If you are over projected the cash flow, you will overvalue the company. So the cash flow that we need to forecast or project for the future must be reasonable. Logic. So that's why you need to do analysis on the previous, and by taking into consideration the economic condition, economic situation, you will then project or forecast the future cash flow for the company. So let's say if, based on the past years, you find out that the average cash flow for the companies is 1 million per year. So based on the previous performance and the economic forecasting, economic situation condition, you will then forecast for the future cash flow for the company. If you forecasted that the company will have 10% increase of their future cash flow, then you should reflect the 10% expected increase in your future cash flow. So this is the limitation of DCF method. So it is quite difficult to use DCF method if the company has negative earnings. So let's say if the company has negative earnings for the past few years, so you may have difficulties in forecasting or projected the future cash flow for the company. So may expect to lose money for some time in the future. Possibility of bankruptcy. May have to consider cash flows after they turn negative or use alternate means. So this is among the challenges or difficulties you may have to face when you are using DCF to value the company. So DCF is one of the method under income approach. So if you look at the current trend, DCF is among the famous method under income approach. By analyzing the past year's cash flow, and you will forecast for the future cash flow, then you will multiply with the specific rate to calculate the future DCF of the company. So again, this is the other limitation or problems that you may have to face when using DCF in business valuation. So may move price during boom and fall recession. Cash flow may get smooth over time
analyst has to carefully study company with a view on the general economic trends. The bias of the analyst regarding the economic scenario may find its way into the valuation model. So this is now lah. Be careful in forecasting the future. You may end up overvalue or devalue the company, which we have to try to avoid lah. By right, you have to give a fair value of the company for the company, not devalue or overvalue. So unutilized asset of business. Cash flow reflects assets utilized by companies. So that's why in order to measure whether the companies has fully utilized its assets, we may need to compute the ROA. What is ROA? ROA is return to asset, return on asset. So ROA will tell us how efficient is the company in using every single dollar, every single ringgit of their assets to generate income, to generate profit. So that's why you need to, again, you need to recall back your knowledge on ROA. ROA is return on asset. ROE is return on equity. ROI is return on investment. You can look back the notes under profitability ratios or for ROE, ROI, ROE. And you need to know lah price earning ratio. So a lot of you need to do a lot of revision on the previous subject that you have learned in your first and second year as far as business relation is concerned. So you just see only for one subject you need to recall back your knowledge from a few subject that you have learned before. So please look at notes on your real estate, notes from your accounting and financial management subject, and notes on your investment subject. You need to know about cash flow, about ROA, ROI, ROE, about WACC, what is WACC, what is CAPM, capital asset pricing model. So you need to recall back all those knowledge. So again, this is the limitation for DCF. Companies with patent or product options, unutilized product options may not produce cash flow in the future, but may be valuable. So if that is the case, you may end up devalue your company, because as far as DCF is concerned, the valuation is done based on the cash flow. So cash flow means that whatever asset, whatever product that the company has utilized to generate income, to generate cash flow. If the product or the asset has not been utilized by the company, meaning that you cannot measure their value as far as cash flow is concerned. So you may end up devalue the company if the company has some of the product or asset which is not utilized. This may be overcome by adding value of unutilized product using option pricing model or estimating possible cash flow or similar method. So again, what is option pricing model? You need to, have you guys learn about OPM ni, of option pricing model ni? Have you studied about pricing model? Yes, no, not sure. The easiest answer is not sure lah. So again, if you look at the DCF ni, there are quite a lot of limitations lah. Companies in process of restructuring, maybe selling or acquiring asset, maybe restructuring capital or changing ownership capital. Difficult to understand impact on cash flow. So it is again, if the company that you are about to value is currently under a restructuring process, you may have some problems, some difficulties in determining the cash flow. So again, this is the process the companies under restructuring. Companies under M&A as merger and acquisition process, again, you may have some difficulties to determine the cash flow of the company, which if they are under M&A process, merger and acquisition. Unlisted companies. For unlisted companies, you may have difficulties to estimate the risk. The historical information may not be indicative of future, particularly in early stage growth phases. Market information on similar companies can be difficult to obtain. This is the case of unlimited company. If you are going to use DCF to value the company, so maybe if you are valuing unlisted companies, maybe DCF or income approach is not suitable to be used. Maybe you should use any other approaches. So that's why at the one of the lecture about the process of business relation, it is mentioned that before you decide which approach to be used, you need to consider, you need to study the suitability of each of the approach first before decide the approach to be used, because you may need to look at the nature of the company that you are going to value, blah 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 blah, before you can decide which approach you use. So that's all about income approach. So now let's move to the final approach, which is market approach. So market approach is also known as relative approach. Assumption is that other firms in the industry are comparable to firm being valued. So one of the method under market approach is comparison method lah. You guys are surely familiar with comparison method when you are doing your real estate valuation subject. You have come across with comparison method. So what we will do with comparison method is we will find a company which has similar characteristic, similar elements of the companies that you are going to value. So we just compare the value of the company is the company that you are going to value. If we have to do some adjustment, we will do some adjustment before we finalize the value to be used for the company that we are valuing. So assumption that is other firms in the industry are to the firm being valued. Standard parameters used like earning, profit, book value. So if you are using market approach, and under market based method ni, comparison method, you may want to compare the standard parameters between the firm that you are going to value with their comparable in the market. So the standard parameters that is used is earnings, profit, book value, etc., etc. So we will look at the comparables earning. We will look at our subject companies earning. We will look at the comparables profit, and we will look at the profit for the company that we are valuing to. So it is quite simple method lah but as far as a business relation is concerned, it is quite challenging to find a company which has similar characteristic with the company that you are going to value. So that is the most challenging part lah, to try to find similar company which has similar characteristic with the company that you are going to value. So adjustment made for variances from standard firms. This can be negative or positive. Again, it's the same when you are doing your comparison method. So when you are doing comparison method, there is element of adjustment to be made. So whenever necessary, if you need to do adjustment, you have to do adjustment lah in order to derive with the value for your subject company. So that is where EBIT, EBITDA comes into pictures. So EBIT, as I explained last time, EBIT is earning before interest and tax. EBITDA is earning before interest, tax, depreciation, and amortization. So you need to know what is the differences between EBIT and EBITDA. When to use EBIT, when to use EBITDA. As far as market approach for business valuation is concerned. Again, this one I think for the exercise we better do during our tutorial, and we will go through. I will explain on how to do the comparison. So for in this slide, we are comparing between 3 different companies before we can derive the value for our subject company, the company that we are going to value. The process is more or less same with the normal comparison method. The only difference is in business relation, we are comparing between our subject company with their similar companies within the similar industries and with a similar size. When you are comparing between the companies, you have to make sure that the size of the company is similar. If it is not similar, then you need to do some adjustment. Try to avoid from a company which has a huge difference in terms of the characteristic, to avoid from having to do a lot of adjustment. If possible, we will try to avoid or reduce the amount of adjustment that we need to do if you are using comparison method under market approach. So if you are choosing to do this method, you have to analyze data for your company, right? Meaning that the company that you are going to value and the company that you are taking as comparison. So you need to analyze all companies' details or data in order for you to derive with the value for your subject company. So again, under exercise ni, this is the example lah. So normally this is what we will do lah, using, if you are using a market approach, basically we are using the comparable method. So, same with a normal comparison method practice, you need to find 2 or 3 comparables to be used before we can derive the value for the company. So using fundamentals for multiples to be estimated for valuation relates multiples to fundamentals of business being valued, earnings, profit. So when we are using a comparison method to value a business, we should look at different multiples or different aspect of the company's performance. So for example, we should look at the company's earning, company's profit, maybe company's expenses. So it depends. So return on asset, return on equity, return on investment. So we need to compare and to analyze all those elements before we derive for our subject company. Using comparables for estimation of a firm value. So again, this is the same process. If you are using a comparison method in valuing a real estate, you need to review all the comparables before you can derive to the value for your subject company. Definition of comparable can be difficult, may range from simple to complex analysis. Again, as I mentioned previously, it all depends on the size of the company. If the nature and size of the company is simple, you may find it is quite simple to use this comparables method under market approach. But if the nature of the company, the size of the company is complicated, then you may find it is difficult to find a comparable, a good comparable to be used. So far, do you have any problems? Do you have any questions to ask?
Sir Zhu, how about our comparables if like example the balance sheet, the ending of period is different? Can we still compare?
Normally, what you have to do is you have to try to find the comparables whereby their end of financial year is not that far. Let's say if the company that you are going to value, the end of financial year is, let's say, in March. So you need to find at least your comparables, your end of financial year, at least within the first half of the year, meaning that between January to June, if possible. If it is not possible, you can use any company which their end of financial year is end of the year or within the third quarter of the year, but you need to do some adjustment. So if possible, we should try to avoid from having to do too many adjustment, because too many adjustment will cause value that you derive at the end of the valuation process to may not be as accurate as possible. So if possible, you have to find like the company which has a quite similar dia punya end of financial year. Dia
Okay.
it's like it's like when you are using comparison method to value residential unit you will try your best to get the comparables as similar as possible to your subject property, right? So it's same with the business lah. You have to find the company which has the similarities as high as possible to avoid from having to do too many adjustment. Right? When we are using the comparable method, we should try to avoid from doing too many adjustment, because kalau too many adjustment ni nanti dia punya ketepatan dia diragui. We can query the value that we get at the end of the valuation process. So this is among the limitation of comparison method under market approach. Easy to misuse. Selection of comparable can be subjective. Errors in comparable firms get factored into valuation model. So this is the normal limitation with comparison method. So I think we stop here. We have briefly je tau, not detail. We have briefly look at different approaches that we can use in order to value a business. We have look at asset approach. So under asset approach, there are a few methods can be chosen. So the next one we have look at income approach. So under income approach, most of the famous or popular method is DCF lah. Then we have look at market approach. Again, under market approach, the most popular method is comparison method lah, whereby you study the market of the similar companies and you will compare between the company that you are going to value with the comparables before you derive to the value for the company. So we will stop here for today. So if you have any questions, you may ask now, because it is 7 minutes to 11. Because if you have another class to after this, I don't want the next lecture complain that I've used their time. Okay, what is your problem?
Regarding the financial statement there, because we have to normalize, which means adjustment to their financial statement. But then it is difficult for us to know that what exactly should be adjusted out. Such as because like in lecturer, you said that certain expenses is not regarding to the business should be adjusted or add back to the balance sheet. But the problem is we couldn't get the detail for this kind of amount.
Do you mean the details for the company or the
details for the things to be normalized?
If you look at the theory, what elements that we should we could normalize. So let's say there are a few types of expenses or elements that should normalize. So for your assignment, you don't choose all of the elements lah. You choose maybe one or two elements that need to be normalized as far as your assignment is concerned. You don't do all of them. Okay, you just because your assignment is as a case study for your subject. So don't make your life difficult. Just get one or two elements that you should normalize and then try to do it. Try to get the elements that you can easily get from the company's statement. Don't choose the difficult one because it is up to your group to decide. If I were you and I just choose one or two elements saja which I need to normalize as only as an example when you are doing your assignment, because in reality pun even in reality it will be based on case by case basis, depend on the nature of the company, the type of the company. As I mentioned last time, there is no right or wrong answer for your apa itu. What is important is you must have justification, strong justification to back up any of your action or any of your arguments when you do your business valuation. So you
Mr. Zhu, later can you upload the PPTX slide? Because it really helps us for the assignment.
slide yang mana?
Slide yang today.
Yalah, I'll upload today lah. But by right, you should not rely on slides so you do your assignment. Kan? Have you tried to look at IACVS website? Can you find any info from IACVS website? Or have you tried to look at BIVAM website, Business Valuation Association of Malaysia website? Maybe you can find some useful information from the other website as far as your assignment is concerned. But for the upload today, so that you can have a look at the slides and then maybe you can use the info in the preparation of your assignments. Okay, Brian. As usual normally after we have done the lecture, I will upload the slides and then I will upload the some tutorial questions for you guys to go through and to try to do.
Okay, thank you, Sir Zhu. Because next week is mid-sem break, so if we get the slides, so maybe you can be first.
You cannot do your assignment without the slide, right? But I thought you already got your senior's copy of the assignment, which is much easier, right? You just copy paste, change the company's name, change the figure, and send to the lecturers. Then maybe you'll get A or maybe you'll get E. Never mind. I will upload the slide. Don't worry. I know that next week is the best time for you guys to concentrate on all of your assignments because you don't have lecture. Maybe you can have one meeting per day for different subjects assignments. So don't worry, I will upload the slide before midnight today
Thank you, Sir Zul.
with your tutorial questions. And inshallah, I have a few useful handouts and notes which I can share with you from my business valuation workshop. But again, because I need to choose what topic to be shared with you guys, because I cannot give all 200-300 pages with you, so I have to copy paste. So it will take some time for me to copy paste. I have to go through all 200-300 pages and choose the best or the relevant topic your subject. So because from the 3 editions of the IACVS booklets too, there are a lot of information. So which is not all applicable to your subject. So I will have a look at all those notes, and then I will share any topic which is applicable and appropriate, relevant to your business subject. So it's already 11 o'clock. So I believe that you have another subject after this. So we may dismiss now and then wait lah for my slide. I think for the slide I can straight away upload the slide, but for tutorial I will upload the tutorial question for midnight tonight. Okay, Brian. Happy?
Happy. Thank you, Sir Zul.
Okay. See you 2 weeks from now. So next week is your semester break. Don't forget about our SRE seminar online on the 18th of November, next Wednesday. All of you are compulsory to join the webinar. So till we meet on the 20-something kan, after your mid-sem break lah. So in the meantime, if you have any problems with your assignment, you may ask lah. Okay, bye-bye.
Thank you, Sir Zul. Bye.
Thank you, sir.
Bye.